U.S. natural gas futures closed Friday on the defensive, breaking below long-term support at $2.75 and setting the stage for a potential test of $2.50. September contracts slid to a 9-month low as cooler weather outlooks, rising output, and comfortable storage levels continue to drag the market lower. Production remains a major headwind. The EIA lifted its 2025 U.S. natural gas output forecast by 0.5% to 106.4 billion cubic feet per day, while projections for 2026 edged up to 106.1 billion cubic feet per day, underscoring persistent supply strength. U.S. dry gas production was reported at 108.4 billion cubic feet per day on Friday, up 6.3% from a year earlier. U.S. gas rigs stand at 122, close to a 2-year high. In short, supply remains firm while demand is starting to soften. Meanwhile, forecasts turn cooler for late August and early September across major demand centers in the East, South, and Midwest. Lower air conditioning use is expected to cut gas-fired power demand, dealing a blow to late summer consumption. U.S. demand stood at 77.9 billion cubic feet per day on Friday, up 9.8% from a year earlier, but the coming dip in temperatures threatens to stall that momentum. Still, the trend could shift back to the bullish side on the monthly chart. While storage forecasts remain above April's levels, analysts expect inventories to move closer to the 5-year average in the coming months, creating upward pressure on prices. After rising by more than 3 billion cubic feet per day in 2025, marketed natural gas production is expected to stall or even decline the following year. At the same time, LNG exports are projected to expand by about 1.9 billion cubic feet per day, further tightening balances and supporting higher prices into year-end and early next year. This outlook, however, could be altered by global developments such as a deepening economic slowdown or the potential restoration of Russian gas flows through Nord Stream 2, once considered highly unlikely but now appearing more plausible in the wake of the recent Alaska summit between Trump and Putin, the details of which remain undisclosed. Another potential signal of an upcoming trend change is the movement of the fair price indicator, which has now crossed above the futures price line. This crossover is often viewed as an early indication that market sentiment may be shifting, suggesting the groundwork for a bullish reversal is starting to form. If this pattern holds, it could mark the beginning of a change in direction after the recent period of weakness. Technical support is under pressure, and traders should keep an eye on $2.85. A sustained move above this level could lift minor momentum, potentially triggering short covering toward $2.90 or even $3. That said, any rebound is likely to encounter selling pressure, as rallies without a meaningful change in fundamentals are often short-lived. Unless $2.90 is convincingly reclaimed with strong volume, lower levels around $2.50 may be tested, with sellers continuing to fade rallies. Overall, upside moves are expected to be brief and driven more by technical factors than by a genuine recovery in demand. Nevertheless, over the medium term, the $2.50 level represents a strong support zone and could prove to be an attractive entry point as the market heads into the winter season. As time progresses and seasonal demand factors come into play, the likelihood of a rebound from this level is expected to increase. Traders and investors may see growing opportunities for positioning ahead of the higher demand winter months, with the potential for prices to recover gradually as supply-demand dynamics tighten. Don't forget to comment, watch the previous video, and show some love for the channel. See you next time.